Friends, thank you for being here today. What if I told you that the gold market you've trusted for decades is a casino where the house just ran out of chips? What if the invisible mechanism that kept gold prices suppressed has just shattered and the banks are scrambling to hide the evidence? This is not a prediction. This is observable fact unfolding in real time. Let me be precise. The spot price of gold is hitting records, surging past $3,450 per ounce. Yet the banks are actively discouraging you from taking physical delivery. Why? Because every ounce you take home is an ounce they can't leverage 100 times. The spread between paper contracts and physical metal tells the truth the spot price hides. And that spread just exploded to $60 per ounce. $60. This was the premium paid per ounce just to switch from a paper contract to a physical bar during the panic. In normal times, this cost is measured in cents. A $60 spread means the bridge between New York paper and London physical is burning. This is the mechanism hiding in plain sight, and it's screaming that something incomprehensibly large is breaking. Here's the part they never put in the official reports. The paper gold market is estimated to be 100 times larger than the physical market. 100 paper ounces traded for every single bar sitting in a vault. For 50 years, this was the game. The banks sold receipts they couldn't honor, and no one asked questions because no one demanded delivery. That era just ended. We are witnessing a run on the exchange. This is vanishing in real time. This is a structural fault line, not a temporary disruption. The COMEX futures market has transformed from a leveraged trading platform into a delivery hub, and the infrastructure cannot handle the weight. In 2025, physical delivery requests hit record highs as confidence in paper settlement collapsed. The institutions aren't rolling over their contracts anymore. They're standing for delivery, and the vaults are empty. The scale of what's unfolding is staggering. For context, historically, less than 1% of COMEX futures contracts resulted in physical delivery. 1%. The system was designed for that load. But when delivery requests surge to 2% or 3%, the mathematics become impossible. The COMEX technically defaults. We are hovering at that edge right now. This part has already begun. Let me show you what actually happened. The Exchange for Physical Mechanism, the EFP, is the emergency exit used to settle contracts in London when New York runs dry. It's the escape hatch the bullion banks rely on when the warehouse receipts don't match the metal. This spread, the cost to swap a New York futures contract for London physical bars, spiked to $60 per ounce for gold and $1 per ounce for silver in late 2024 and 2025. This isn't a trading glitch. It is a signal that the physical metal isn't there. But that's not the real problem. The real problem is what this reveals about the architecture of the entire precious metals market. To understand why this moment is inevitable, we need to go back to the origin, not to last month's headlines, but to the foundation itself, because this crisis didn't start in 2025. It started the moment the system decided that gold was too inconvenient to actually hold. Let's cut through the noise. In July 2025, the final implementation of Basel III rules in the United States reclassified the very nature of gold as a financial asset. Under these new regulations, unallocated gold, the paper contracts and bank IOUs that make up the bulk of the gold market, became classified as a risky asset with Tier 3 behavior. Meanwhile, physical gold, the actual bars sitting in vaults, became a risk-free asset with Tier 1 status. Here's what that looks like on the ground. Tier 1 assets are treated like cash. They require minimal capital cushions for banks to hold them. Tier 3 assets require massive capital reserves. Overnight, Basel III made it expensive for banks to hold paper gold and profitable to hoard physical gold. This incentivized the very behavior we're seeing now: dump the paper contracts, scramble for physical bars, the leverage unwind. This is where the domino setup becomes visible. The banks built their trading desks on the assumption that delivery would remain rare. They sold 100 paper ounces for every bar they possessed, collecting premiums and fees, confident that the music would never stop. Basel III tipped the first domino. Now the entire cascade is in motion. And here is where the countdown quietly began. The mechanism they used to suppress gold prices for decades was called rehypothecation. Think of it like this: a single bar of gold sits in a vault. That bar is leased to a trader. The trader uses it as collateral to borrow more funds. Those funds buy another claim on gold, which is then leased again. The same bar has been sold, leased, and collateralized 5, 10, maybe 20 times. As long as no one asks for delivery, the illusion holds. But once delivery demands rise, the musical chairs stop. There is only one chair for every 100 players. Let me be precise about what we're watching. The COMEX registered inventory, the gold available for immediate delivery, has been drained by record central bank buying. Over the past 3 years, central banks have purchased more than 1,000 tons of gold per year. Eastern demand, particularly from China and India, has compounded the pressure. Western vaults are facing a liquidity crisis, and the warehouse receipts don't match the metal. This is the detail even analysts tend to miss. The gold market distinguishes between two categories: eligible and registered. Eligible gold is metal stored in COMEX warehouses, but it's not for sale. It belongs to someone who's just using the vault for safekeeping. Registered gold is metal available for delivery, the only inventory that actually matters for pricing. And registered gold has been plummeting. Here's where everything changes. In December 2025, during the delivery cycle, reports confirmed that commercial shorts, the bullion banks, were scrambling to cover positions as the EFP mechanism failed to contain the pressure. More contracts were being forced into cash settlement instead of metal delivery. This is the polite term for default. You bought gold. They gave you a wire transfer. The receipt is not the rock. But this isn't even the part that scares me. What scares me is the seller's strike. Eligible gold, the metal sitting in vaults but not available for sale, is not moving into registered status. The owners are refusing to sell at these prices. They see what's coming. They understand that once the paper market collapses, the price discovery mechanism shifts entirely to physical metal, and physical metal trades at a premium that reflects reality, not leverage. This is where the crack becomes an earthquake. The Asian premium is the forensic evidence. Physical gold in Shanghai is trading at a significant premium to New York and London. Metal flows to the highest bidder, and the highest bidders are no longer in the West. The vaults are being drained eastward, and the banks cannot stop it. Every ounce that leaves is an ounce they can't use to settle the next contract. The liquidity tide is going out, and we are about to find out who is swimming naked. Let me show you the convergence. We are facing three distinct forces hitting simultaneously. First, the regulatory shift. Basel III makes paper gold expensive and physical gold profitable. Second, the operational failure. The EFP spreads prove the logistical system cannot deliver. Third, the behavioral change. Investors are demanding possession, not promises. These three forces are not independent. They are reinforcing each other, accelerating the collapse. This is not theoretical, it's observable. The London-New York spread blew out to $20 per ounce earlier this year because the physical metal wasn't there. That spread is the arbitrage between two of the world's largest gold trading centers. In a functioning market, that spread should be pennies. When it's $20, it means the supply chain is broken. When it hits $60, it means the system is in full crisis. And this part is non-negotiable. The bank sold you a receipt. Now everyone wants the bar. For decades, this worked because the demand for physical delivery was minimal. Traders were happy to settle in cash, take their profits, and roll into the next contract. But confidence is a fragile thing. Once it cracks, the flood begins. We haven't even reached the breaking point yet. The breaking point arrives when delivery requests exceed the system's capacity to deliver. Remember, the COMEX was designed for a 1% delivery rate. If that rate doubles to 2%, the strain becomes unbearable. If it hits 3%, the default becomes unavoidable. We are watching the delivery requests climb in real time. The data forces one conclusion. This was inevitable the moment Basel III was implemented. Here's the part nobody expects. The banks are not going to announce the default. There will be no press conference, no official statement admitting they sold gold they didn't have. Instead, you'll see a surge in cash settlements. You'll see delivery delays. You'll see premiums on physical metal widen further. The default will be quiet, bureaucratic, hidden behind legal language about force majeure and market disruptions. This is a default in all but name. Let me show you what the insiders are watching. The registered inventory at COMEX has been hovering near historic lows. Every month, the delivery cycle tests whether the system can honor its contracts. And every month, the strain grows. The eligible gold sitting in vaults is not being converted to registered status fast enough. The owners of that metal know what it's worth. They're not selling at suppressed prices. This leads us to the system's most crucial secret, which we will explore in the next section. Because what I'm about to show you explains why this crisis cannot be solved by printing more money, by lowering interest rates, or by regulatory intervention. The foundation itself is cracked, and no amount of scaffolding can hold it together. But before we get there, let's talk about what this means for the average person watching this unfold. For the average household, this means the wealth you thought you owned might be nothing more than a claim on wealth that doesn't exist. Let me walk you through the mechanics of how this trap was set, because understanding the architecture of this system is the only way to see why the collapse is mathematically certain. Here's the part the experts gloss over. When you buy a gold ETF, when you open an unallocated gold account at a bank, when you purchase a futures contract, you are not buying gold. You are buying a promise. You are buying credit exposure to an institution. And if that institution fails to deliver, you become an unsecured creditor standing in line with everyone else who believed the receipt was the same as the metal. The simple logic does not apply here. In a normal market, if demand exceeds supply, the price rises until equilibrium is restored. But the paper gold market doesn't follow normal rules because the supply is artificial. The banks can create infinite paper claims on gold without ever touching a physical bar. They print contracts the way central banks print currency. And just like currency, those contracts are only worth something as long as confidence holds. This is where common sense actually becomes your enemy. You look at the spot price of gold and think that's what gold is worth. But the spot price is set by paper trading, by the leverage game, by contracts that will never result in delivery. The real price of gold, the price you pay when you want the actual metal in your hands, is telling a very different story. And that story is about scarcity. Let me be precise about the timeline. The Basel III implementation didn't just change accounting rules. It changed the incentive structure for every major financial institution. Before July 2025, holding unallocated gold was cheap and easy. After July 2025, it became expensive and risky. Banks had to maintain an 85% net stable funding ratio, which meant they needed to back their gold exposure with actual capital or actual metal, and here is where the first domino falls. The banks couldn't find the metal. Central banks had been vacuuming up physical gold for 3 consecutive years, buying over 1,000 tons annually. Eastern buyers, particularly Chinese and Indian institutions, were taking delivery of everything they purchased. The Western vaults, which had operated on fractional reserve principles for decades, suddenly faced a supply crisis. The metal was gone. It had flowed east, and it wasn't coming back. But once this shifts, everything above it starts to shake. The EFP mechanism was supposed to be the safety valve. When New York couldn't deliver, London would step in. When London ran low, metal would flow from Zurich or from Toronto. The global supply chain was supposed to be seamless, with arbitrage keeping prices aligned across markets. But in late 2024, that mechanism broke. The London vault stopped bailing out New York. The spread between paper and physical widened. The safety valve failed. This is not a conspiracy, it is a stated policy. The Bank for International Settlements, the central bank for central banks, explicitly redesigned the regulatory framework to favor physical gold over paper gold. They published the Basel III guidelines years in advance. They gave banks time to prepare. The banks chose not to prepare. They chose to keep playing the leverage game, confident that delivery would remain rare and that the paper market could continue indefinitely. They were wrong. And this part isn't a prediction, it's math. If 2% of paper gold holders demand delivery, the system breaks. If 3% demand delivery, the system collapses entirely. We're watching the delivery rate climb in real time. December 2025 saw delivery requests surge beyond historical norms. The commercial shorts, the bullion banks who sold gold they didn't have, are scrambling to close positions. They're offering cash settlements. They're delaying deliveries. They're invoking obscure contract clauses that allow them to settle in currency instead of metal. This is where the cascade becomes unstoppable. Because once the first cash settlement happens, once the first contract is defaulted, confidence evaporates. The remaining paper holders realize they're playing musical chairs, and there aren't enough chairs. The rush to demand delivery accelerates. The pressure on the vaults intensifies. And the banks have no solution because the metal doesn't exist. Here's what that looks like in practice. You own a gold futures contract. You decide you want delivery. The exchange contacts you and says, "We can settle this contract in cash at the spot price, or we can delay delivery by 60 days due to logistical challenges, or we can offer you an EFP to take delivery in London at a $60 premium." Every one of those options is a soft default. Every one of them proves the receipt is not the rock. We don't have months. This is happening in days. The warehouse receipts tell the story. COMEX reports its inventory in two categories: eligible and registered. Eligible gold totals might look impressive, hundreds of tons sitting in vaults, but that metal isn't for sale. It belongs to someone who's just storing it there. Registered gold, the metal actually available for delivery, has been plummeting, and the owners of eligible gold are refusing to convert it to registered status. This is the seller's strike, and it's rational behavior. Why would you sell your physical gold at suppressed paper prices when you can see the paper market is collapsing? Why would you hand over real metal in exchange for currency that's being debased by the trillions? The owners of physical gold understand what's coming. They're holding tight. And here is where everything changes. The Asian premium is the forensic evidence that destroys the illusion. In Shanghai, physical gold trades at a significant premium to London and New York. Sometimes that premium is $30 per ounce. Sometimes it's $50. The metal flows to the highest bidder, and the highest bidders are in the East. Every ton that ships to Shanghai is a ton that can't be used to settle COMEX contracts. The vaults are being drained, and the drain is accelerating. For pensions, this is catastrophic. Pension funds hold gold ETFs, believing they own an inflation hedge, believing they own a safe haven asset. But when the paper market defaults, those ETFs will be settled in cash. The fund managers will receive a wire transfer at the suppressed spot price, and they'll have to explain to retirees why their gold position evaporated. The retirees won't get metal, they'll get currency, and that currency will be worth less every day as the monetary system responds to the crisis with more printing. This is where the moment the clock actually starts. The trigger isn't just Basel III. The trigger isn't just the delivery requests. The trigger is the recognition spreading through the institutional world that paper gold and physical gold are no longer the same asset. One is a derivative, a promise, a claim on something that might not exist. The other is a tangible store of value with no counterparty risk. And the institutions are figuring this out. Let me show you the canaries in the coal mine. Canary number one, cash settlements. More COMEX contracts are being settled in cash instead of metal. The exchange isn't advertising this. You have to dig through the delivery reports to see it. But the trend is unmistakable. The percentage of contracts resulting in physical delivery is rising, but the percentage being forced into cash settlement is rising faster. The system is rationing metal. Canary number two, delivery delays. Contracts that should settle in days are taking weeks. Excuses about logistics, about refining capacity, about transportation challenges. These are cover stories. The real issue is the vaults don't have the metal to deliver immediately. They're scrambling to source it, buying from other institutions, pulling from eligible inventories, begging owners to convert their stored metal into registered status. Canary number three, the premium explosion. The cost to take delivery, the cost to acquire physical metal instead of paper claims, has spiked to levels that would have been unthinkable 2 years ago. A 60 EFP spread means the bridge between paper and physical is broken. It means the arbitrage mechanism that kept markets aligned has failed. It means we're watching two markets diverge in real time. But that's not even the worst part. The worst part is rehypothecation. The same bar of gold has been leased, sold, and collateralized multiple times. This is standard practice in the bullion banking world. A central bank leases gold to a bullion bank. That bullion bank uses the gold as collateral to borrow funds. Those funds are used to purchase more gold claims, which are then leased to another institution. The chain continues. One physical bar supports 10, 20, maybe 50 paper claims. This sounds insane, but the data is unambiguous. The leverage ratio in the gold market is estimated at 100 to 1. 100 paper ounces traded for every physical ounce in existence. This worked as long as delivery remained rare. But when delivery requests surge, the chain snaps. The institution at the end of the chain demands their metal. The institution before them can't deliver because they leased it to someone else. The unwind begins, and there's no way to stop it without a default. Here is where the countdown becomes visible to everyone. You cannot solve a physical shortage with monetary policy. You cannot print gold. You cannot lower interest rates and make more gold appear in vaults. You cannot issue more paper contracts and transform them into metal. The only solution is default, cash settlement, and a repricing of physical gold to reflect actual scarcity. This is the moment small businesses get crushed, not because they own gold, but because they depend on the financial system functioning normally. When the COMEX defaults, when the paper gold market collapses, the contagion spreads, confidence in other paper markets erodes, derivatives markets seize up, liquidity drains from the system, and small businesses which operate on thin margins and depend on credit lines find themselves unable to access capital. The liquidity tide is going out, and we are about to find out who has been swimming naked. Let me walk you through what the no escape encirclement looks like. You might think, I don't own gold, so this doesn't affect me. But the collapse of the paper gold market is a symptom of a much larger structural problem. It's proof that leverage has exceeded reality across the entire financial system. Gold is just the first market where the math has become impossible to hide. Stocks? Liquidity is draining as institutions scramble for physical assets and cash reserves. Tech stocks, which thrived in a zero interest rate environment, are getting crushed as capital costs rise and as the monetary illusion fades. Bonds? Yields are spiking as confidence in sovereign debt erodes. Governments have borrowed beyond their capacity to repay, and the bond market vigilantes are demanding higher premiums for the risk. Cash? Inflation is eroding purchasing power faster than interest rates can compensate. You become a millionaire on paper, but poorer at the grocery store. The money illusion is everywhere. Real estate? Prices are inflated by decades of cheap credit. As rates rise and as liquidity tightens, the bid disappears. Sellers can't find buyers. Mortgages become unaffordable. The asset that was supposed to be your nest egg becomes an anchor, and here's where everything converges. We are facing a convergence of three distinct structural breaks happening simultaneously. First, the regulatory earthquake. Basel III has reclassified the entire gold market, making paper toxic and physical precious. This isn't a temporary policy shift. This is a permanent rewriting of the rules. Second, the operational collapse. The EFP spreads, the delivery delays, the cash settlements prove the logistical infrastructure cannot handle delivery demand. The bridges between markets have burned. Third, the behavioral transformation. Investors, institutions, and central banks are all demanding possession instead of promises. These three forces are not independent variables. They are reinforcing loops, each one amplifying the others, accelerating the timeline toward inevitable default. This part is non-negotiable. The paper gold market will default. Not might default, will default. The only questions are when and how messy the process becomes. The mathematics are inescapable. When you have 100 paper claims on every physical ounce, and when delivery requests exceed 1%, the system breaks. We are watching delivery requests surge past historical norms right now. The breaking point is not theoretical. It is observable, measurable, and unavoidable. Let me show you what actually happened in previous market dislocations to understand what's coming. In 1980, the Hunt brothers tried to corner the silver market. They took delivery, they demanded physical metal, and the exchanges changed the rules mid-game to survive. They limited position sizes, they raised margins, they forced liquidation. The system protected itself by altering the contract terms retroactively. Here's the part nobody expects. That playbook won't work this time. In 1980, it was two brothers trying to corner a market. Today, it's central banks, sovereign wealth funds, and institutional investors across Asia and the Middle East, all demanding delivery simultaneously. You cannot change the rules when the buyers are nation states. You cannot force liquidation when the demand is coming from entities that don't need leverage, that have unlimited currency to spend, and that view gold as a strategic asset more important than short-term profits. The dam is cracking and there's no way to plug the holes. Human beings are hardwired to believe tomorrow will look like yesterday. This is normalcy bias, and it's the most dangerous assumption you can make right now. You see the spot price of gold rising and you think, well, it's been volatile before, it always stabilizes. You see premiums on physical metal spiking, and you think that's probably temporary, some logistical issue that will resolve itself. You see delivery delays, and you think supply chain problems, nothing unusual in 2025. Every one of those thoughts is your mind protecting you from a truth too uncomfortable to accept. The truth is that the system you've trusted your entire life, the system that promised you could always exchange paper for metal, that system is breaking. And it's breaking because it was always a fraud. It was always 100 claims on one bar. It only worked because no one tested it. Now everyone is testing it, and it's failing the test. This is where the psychological trap becomes visible. You don't want to believe the financial system could be built on leverage this extreme. You don't want to believe the banks sold gold they didn't have. You don't want to believe the regulatory agencies knew about this and allowed it to continue. But wanting something to be false doesn't make it false. The evidence is in front of you. The EFP spreads, the delivery delays, the cash settlements, the Asian premiums. Every data point confirms the same reality. The receipt is not the rock. Let me be precise about what this means for different types of gold holders. If you own a gold ETF, you own shares in a fund that owns paper claims on gold. When the paper market defaults, that fund will receive cash settlement. You will not get metal. You will get a wire transfer at a suppressed spot price determined by the very paper market that just collapsed. Your inflation hedge will evaporate at the moment you need it most. If you own an unallocated gold account at a bank, you own a credit exposure to that institution. You are an unsecured creditor. If the bank cannot source physical metal to honor your claim, you will stand in line with all the other unsecured creditors, hoping there's something left after the secured creditors are paid. This is not speculation. This is the legal structure of unallocated accounts. If you own gold futures contracts, you own a derivative that can be cash settled at the exchange's discretion. The contract terms explicitly allow for this. You might demand delivery, and the exchange might simply wire you currency instead. You have no recourse. The contract you signed gave them that option, but this isn't even the part that scares me most. What scares me is the second order effects. When the paper gold market defaults, confidence in paper silver, paper platinum, paper palladium will collapse immediately. The contagion will spread to other commodity markets. Traders will question every futures contract, every ETF, every unallocated account. The entire derivatives complex, which is built on the assumption that settlement in kind will remain rare, will face a crisis of legitimacy. And here is where the cascade accelerates beyond control. The global derivatives market is estimated at over $600 trillion notional value. Most of those contracts are cash settled, but they're all built on the same mathematical foundation, leverage exceeding reality. When one market proves that the paper claims exceed the physical assets by 100 to 1, every other leverage market comes under scrutiny. The questions multiply. How much real oil backs the oil futures? How much real copper supports the copper ETFs? How many treasury bonds actually exist versus how many claims on treasury bonds? This is the crack that becomes an earthquake. The financial system is an edifice built on confidence. When confidence shatters in one market, the fracture lines spread to adjacent markets. Gold is the canary because it's the oldest, most scrutinized, most liquid precious metal. It's the market where the leverage has been tested first, but every market is playing the same game. Every market has sold more paper claims than physical assets, and every market is vulnerable to a run. Let me show you what the endgame looks like. There are only two possible outcomes. Outcome one, the exchanges default, cash settle the contracts, and physical gold reprices to reflect actual scarcity. In this scenario, the spot price becomes irrelevant. The only price that matters is the price you can actually buy physical metal for, and that price will be multiples of the current suppressed spot price. Outcome 2. The central banks intervene, backstop the bullion banks, and provide emergency liquidity to prevent default. But this requires them to either confiscate gold from private holders, which is politically explosive and legally complex, or to print enough currency to buy gold at any price necessary to honor delivery demands. Both options end with the same result: a massive repricing of gold relative to currency. There is no third option. There is no scenario where the paper market continues operating as it has for 50 years. The mathematics will not allow it. The delivery demands will not subside. The vaults will not magically refill. The leverage unwind is inevitable. Here's the moment the clock actually starts ticking with urgency. You have a binary choice to make. Do you own assets or do you own claims on assets? Do you hold physical metal that has no counterparty risk? Or do you hold paper promises from institutions that might not survive the default? This is not an investment decision. This is a survival decision. The choice is between fake and real. Stocks are claims on corporate earnings, denominated in currency that's being debased. Bonds are claims on government revenue, backed by the printing press. Cash is a claim on future purchasing power, eroded by inflation every single day. These are all abstractions, all paper, all dependent on the system continuing to function. Gold and silver are different. They are physical assets. They have no counterparty risk. They cannot be printed, created, or inflated. They have been money for 5,000 years because they are scarce, durable, divisible, and universally recognized. When the paper markets collapse, when the confidence in derivatives evaporates, when the banking system freezes, gold and silver remain. They are the bedrock beneath the scaffolding. Let me be clear about what I'm advocating. This is not about getting rich. This is not about speculating on price movements. This is about stepping out of the line of fire. When you hold physical gold or silver, you are no longer exposed to the counterparty risk destroying the paper markets. You are no longer dependent on a bank honoring an unallocated account. You are no longer hoping an exchange will deliver instead of cash settling. If you can't hold it, you don't own it. This is the fundamental principle that separates real assets from financial claims. The window for preparation is closing. The COMEX registered inventory is at historic lows. The premiums on physical metal are at historic highs. The delivery delays are lengthening. Every week it becomes harder to source physical gold and silver at anything close to spot prices. The dealers are rationing, the mints are backed up, the refineries are running at capacity, the supply chain is straining. This is vanishing in real time. You might be thinking, I'll wait and see how this plays out. I'll watch for more confirmation before I act. But that is precisely the normalcy bias I warned you about. By the time the default is officially announced, by the time the cash settlements are widespread, by the time the repricing is undeniable, physical metal will be unavailable at any reasonable premium. You will not be able to buy what you need because everyone else will be trying to buy at the same moment. History favors the prepared, and preparation means action before the crisis is obvious to everyone. Let me walk you through the practical steps. First, understand the difference between allocated and unallocated gold. Allocated means specific bars are assigned to you, stored in a vault, and you have legal title to those exact bars. Unallocated means you have a claim on a pool of gold and you are an unsecured creditor of the institution. If you hold unallocated gold, convert it to allocated or take delivery immediately. Second, if you own gold ETFs, understand that you do not own gold. You own shares in a fund that owns paper claims. Those claims will be cash settled in a default scenario. If you want gold exposure that will survive the paper market collapse, you need physical metal or allocated storage. There is no middle ground. Third, when buying physical metal, expect premiums over spot. This is not a rip-off. This is the market pricing and the difference between paper promises and physical delivery. The premium is the truth the spot price hides. Pay the premium, take delivery, and store it securely. Fourth, understand that this is a Tier 1 asset under Basel III. Physical gold is now classified as equivalent to cash for banking purposes. This is the regulatory recognition that gold is not a speculative commodity. It is a monetary asset, a reserve asset, a foundation of the financial system. The rules have changed to reflect this reality. The data forces one conclusion. We are watching the largest wealth transfer in modern history unfold in slow motion. Wealth is moving from paper claims to physical assets, from the West to the East, from institutions that trusted leverage to individuals and nations that demanded possession. This transfer is accelerating. The COMEX default, when it comes, will mark the moment the transfer becomes undeniable to everyone. But once this shifts, everything above it starts to shake. The dollar's role as the global reserve currency depends on confidence. When the US-based COMEX defaults on gold delivery, when the world sees that America's gold markets are built on fraud, confidence in dollar-denominated assets will erode. Central banks will accelerate their diversification into gold. The dollar's purchasing power will decline, and Americans holding dollar-denominated assets will watch their wealth evaporate in real terms even as the nominal numbers rise. This is the money illusion. You become a millionaire on paper, but poorer at the grocery store. Friends, I want to be clear about something. I take no pleasure in delivering this message. I wish the system was stable. I wish the leverage was sustainable. I wish the paper gold market could continue functioning as it has. But wishing does not change mathematics. And the mathematics are screaming that we are at the endgame. The reluctant prophet speaks not because he wants to, but because he must. Because silence in the face of structural collapse is cowardice. Because you deserve to know what the insiders know. Because preparation is the only rational response to inevitable crisis. The edifice is crumbling. The foundation is cracked. The scaffolding cannot hold much longer. The only question is whether you will be standing outside when it falls, or whether you will be trapped inside, holding paper claims on assets that no longer exist. This is not a drill. This is not a warning about a distant future. This is happening now. The delivery requests are surging now. The premiums are spiking now. The vaults are being drained now. Every day you wait is a day the window closes further. History favors the prepared, and the window for preparation is closing. The choice is yours. The information is in front of you. The evidence is overwhelming. What you do with it will determine whether you preserve your wealth through the coming reset or whether you watch it vaporize along with the paper markets. Friends, thank you for being here today. Thank you for taking the time to understand what's happening beneath the surface. Thank you for having the courage to question the narrative and to seek the truth. The road ahead will be turbulent, but those who prepare, those who understand the difference between paper and physical, those who act before the crowd, will navigate this crisis successfully. The receipt is not the rock, remember that, and act accordingly.